Welcome back to the deep dive. We're diving into personal finance and investing today using the simple path to wealth as our guide. And from the stack of notes and highlights you've sent over, it seems like you're looking for a clear roadmap to build that lasting wealth.
Absolutely, and it's easy to get lost in the sea of conflicting advice, you know? But this book, it really boils things down to those simple and enduring principles. It's not about getting rich quick or trying to, beat the market.
Yet it's about building a solid foundation,
Yeah.
one that can weather those market ups and downs.
Mm.
And one thing that jumped out at me was the concept of FU money.
Right.
I have to admit, the name's a little strong, but I get the idea behind it. It's about having that financial security.
Exactly. It's about having that freedom to make choices that align with your values. Like, even if it means walking away from a job you don't like or maybe taking a break to be with family.
Yeah. The author's story about quitting his job at 25 with only $5,000 saved, that was pretty striking. It wasn't even about the amount, but just the freedom it gave him to take that risk.
What's interesting is how that small amount, it gave him the leverage to negotiate his exit. He had enough to cover his needs while he figured things out.
Hmm.
That's a powerful lesson, especially for anyone who feels stuck.
Yeah, it makes you realize you don't have to wait to be a millionaire to start making those choices,
Yeah.
to put your well-being first.
A small cushion can make a world of difference.
And building that cushion usually means tackling, well, debt. The book calls it slavery, which might sound extreme, but think about it.
Right.
Debt really can hold you back from reaching your goals.
It's like an invisible chain. It limits your choices, and it weighs you down.
Constantly playing catch-up instead of building that brighter future.
It challenges the idea of good debt, too,
Uh-huh.
arguing that even mortgages and student loans should be looked at carefully. It lays out the reality of American debt, stating that we're carrying something like $12 trillion collectively.
Wow, that's a staggering number.
Yeah.
It's a reminder that debt's a serious issue. It's not always about, frivolous spending. It can quickly snowball and really impact your life.
Yeah.
The book really hammers home that financial freedom starts with getting out of debt.
It does. Once you're free from that, you can start building long-term wealth. And the book's argument is that the most effective way to do that is through index funds,
Yeah.
specifically Vanguard's Total Stock Market Index Fund, VTSAX.
Now, I have to admit, index funds they're a bit fuzzy for me. What makes them so special? And why this specific fund?
Sure. An index fund is essentially a basket of stocks. It tracks a specific market index, like the S&P 500. And VTSX, it tracks the entire U.S. stock market. So you're exposed to thousands of companies.
So instead of picking individual stocks, which is, inherently risky, you're betting on the overall growth of the market.
That's it. And the book explains that VTSAX is self-cleansing. As companies perform well, they become a bigger part of the fund. And those that underperform, well, they shrink. So you're always invested in the strongest companies.
That makes sense. But I've always heard the stock market's risky.
Mm-hmm.
What about those ups and downs? Doesn't that self-cleaning mean constant buying and selling within the fund? And how does that affect, things like taxes?
Those are great questions. Yes, the market is volatile, but the book's point is that volatility is normal. Trying to time the market is a fool's errand.
Yeah, I can see the temptation. It's like trying to predict the weather, right?
Precisely. And as for the taxes, VTSAX is designed to be tax efficient. The buying and selling happen within the fund itself.
Mm-hmm.
So you usually don't see those capital gains until you sell your shares.
So it's not about avoiding volatility, but riding it out, focusing on that long-term growth.
Exactly. They use a compelling example from the Dow Jones. If someone invested $1,000 in 1974 and held it until 2015, it would have grown to almost $90,000, even with all the crashes and corrections along the way.
That's pretty amazing. It really highlights the potential, even with the turbulence.
The book acknowledges it can feel like an emotional roller coaster, but it encourages you to toughen up and ride it out. They even quote Warren Buffett. He said, "The Dow started the last century at 66 and ended at 11,400. How could you lose money during a period like that? A lot of people did because they tried to dance in and out."
It's a reminder that patience and discipline are key, right? It's not about getting rich quick.
Yeah.
It's about steady growth.
It is. And speaking of discipline, the book also gets into those psychological traps that can sabotage even the best intentions.
Oh, I'm sure we've all fallen into those at some
Mhm.
point. What are some of the big ones to watch out for?
One of the biggest ones is trying to pick individual stocks. It's tempting to think you can, outsmart the market, find that next Apple or Tesla. But even the pros, they struggle to beat the market consistently.
Right, I read that most actively managed funds, those with stock pickers, actually do worse than the market.
Yeah. And even if you pick a winner, it's tough to know when to sell. You might get greedy, hold on too long, or panic and sell too early. It's emotional.
So sticking with index funds like VTSAX, it takes that emotion out of it.
It does. It's a disciplined approach. Another trap is chasing those hot mutual funds.
Oh, those ads with the sky-high returns. I've been tempted.
Easy to get caught up in the hype, but they often cool down fast, and then you're left with losses. The book also warns about financial media, you know?
So those market predictions, take them with a grain of salt. It's hard to tune out sometimes.
It is. The media, they love to create that sense of urgency, that fear, but the reality is most of those experts are just guessing.
That's good to know. The book uses a good analogy, right? The beer and foam one, to explain the difference between a business's value and the stock market's price.
Oh, I love that one. The beer, that's the actual companies, their earnings, their growth, and the foam. That's those daily ups and downs, those fluctuations.
So the market's always going to be noisy, but it's
Yeah.
the businesses that matter long term. We should focus on the quality of the beer, not get distracted by the foam.
Exactly. The book outlines two portfolio strategies, wealth accumulation and wealth preservation. Depends where you are in your journey, you know.
So if I'm still earning, focused on building wealth, what should I be doing?
The book recommends going all in on VTSAX, that total stock market index fund. Maximize growth while you have time to ride out the bumps in the road.
Makes sense. But as I get closer to retirement, I'm guessing my risk tolerance changes.
Absolutely.
Oh, yeah.
As you shift to wealth preservation, the book suggests adding bonds. They're less volatile than stocks, provide a steadier income stream. The recommended one is Vanguard's Total Bond Market Index Fund, VBTLX.
So it's like adjusting the risk dial on your portfolio
Oh, wow.
based on how comfortable you are and how soon you need the money.
Precisely. And speaking of accessing funds, the book emphasizes tax-advantaged investing. Using accounts like 401ks and IRAs can make a huge difference over time.
I know these accounts can be confusing. What makes them so advantageous?
A 401k is a retirement savings plan offered by employers. You contribute pre-tax dollars, and your investments grow tax-deferred. You don't pay taxes until you withdraw the money in retirement.
So it's like a tax break now, and your money grows tax-free until you need it.
Right. Many employers even match your contribution, free money. An IRA, or individual retirement account, offers similar benefits but isn't tied to an employer.
There are different types, though, right?
Okay.
What's the difference between traditional and Roth?
Traditional IRA, you contribute pre-tax, earnings grow tax-deferred. You pay taxes when you withdraw in retirement. Roth IRA, you contribute after tax, so no deduction up front. But your earnings grow tax-free, and withdrawals in retirement are tax-free too.
Sounds pretty good. How do I know which one's right for me?
It depends on your situation, your tax bracket now versus in retirement. The book goes deeper into the details to help you decide.
That's helpful. The book also talks about the 4% rule, which has always intrigued me. How does that work? Why is it important for retirees?
It's a guideline for how much you can safely withdraw each year from your portfolio without running out of money. The idea is if you withdraw 4%, adjusted for inflation, you're likely to make your money last for 30 years or more.
So say I have $1 million portfolio. I could withdraw $40,000 the first year and then adjust that up each year with inflation.
Yeah, that's the basic idea, but it's not a set it and forget it formula. Your actual rate might be different based on your circumstances, the market, and how long you live.
So it's a planning tool, not a guarantee. What about Social Security? What does the book say about that?
It acknowledges the uncertainty around it, the debates about whether it'll be around long term.
Makes retirement planning even more complicated, I bet.
It does add complexity. But the book advises to plan as if Social Security won't be there, not to be pessimistic, but to ensure you're not relying on something that might not be there.
Taking control of your own destiny, not depending on a system that might not be reliable.
Right. The book does offer guidance on when to claim Social Security benefits to get the most out of it. It recognizes it's still a valuable program, even if it's not your only source of income.
Now, I remember from your notes that the book talks about financial advisors, and that could be, well, a bit controversial. What's the author's take on that?
Well, he really encourages readers to think about if they actually need an advisor. He makes the case that a lot of times advisors put their own interests ahead of their clients.
That's a bold statement.
He doesn't hold back. He points out there's often a conflict of interest in that traditional model. Advisors, they're incentivized to sell you those complex investments, the ones with all the fees, even if simpler, lower cost options would be better for you.
So it's not always about what's best for the client, but what makes the advisor the most money.
That's his argument. He calls them out for pushing products that might sound good but end up underperforming and eating into your returns.
It's a reminder to do your homework, right? Don't just blindly trust someone, even if they have all the fancy credentials.
Exactly. And it's not just the commission-based model he criticizes. He also talks about the fee-based model, where advisors charge a percentage of your assets.
I always wondered about those fees. They seem small at first, but I guess they can add up over time.
That's the thing. Those percentages, they can take a big chunk out of your returns, especially over the long term. It's money that could be growing in your portfolio instead of going to fees.
It makes you really think about whether those fees are worth it.
And beyond just the money, he challenges the idea that you need an expert to manage your investments at all.
Uh-huh.
He argues that with a little education, you can do it yourself.
It's kind of empowering, isn't it? Taking control of your own finances.
It is. It's about being financially literate, making your own decisions.
Now, one thing that surprised me was his stance on dollar cost averaging. I always thought that was a safe approach.
Right. The idea is to reduce risk by spreading out your investments, so you're not putting everything in at once.
Exactly.
He actually advises against it in most cases. He says lump sum investing, putting a larger amount in all at once, usually does better.
Really? Why is that? It seems like dollar cost averaging would be less risky.
He explains that while it might feel safer, it often leads to lower returns over time because some of your money's just sitting there, not invested, missing out on growth.
So the longer you wait, the more potential you lose.
That's it. He points out that historically, the market goes up more often than it goes down. So statistically, the sooner you invest, the better.
It's like that saying, time in the market beats timing the market.
Exactly. He does say dollar cost averaging might make sense in some cases, like if you're investing a huge amount all at once and want to spread the risk.
Or if you're just starting out, building your portfolio slowly.
Right. But for most people, he says, get your money in and let it work for you.
It's about getting past that fear, that fear of missing out and trusting the market over time. Now, I have to ask about the section on becoming a stock market guru. Did he actually reveal the secret to predicting the market?
Not quite. He actually makes fun of the whole idea of market predictions and those so-called gurus.
Yeah.
He says it's easy to look like you know what you're doing just by making enough guesses. Some of them are bound to be right, and those are the ones people remember.
It's like those psychics who make those vague predictions.
Yeah, right. I mean,
they can fit almost anything.
Exactly. It's a reminder to be skeptical of anyone who says they know what the market will do. Focus on what you can control, like your savings rate, your investments, your own behavior. Let the market do its thing.
Sounds like good advice to me.
Yeah.
Don't get distracted by the hype. Now, beyond just investing, the book also talks about giving back.
Yeah, he says true wealth isn't just about having money, but using it to make a difference. He tells a story about giving a gourmet dinner to his daughter's teachers and how that one act kind of sparked a chain reaction of kindness.
That's a great story. It shows how money can be a tool to create positive change, both for yourself and others.
And in the end, that's what financial freedom is about. It's not the money itself, but the freedom it gives you to live a life you value.
To pursue your passions, to make an impact. It's about having the choice to work because you want to, not because you have to. Having the security to take risks, follow your dreams, and live a meaningful life.
It is. It's about making money the tool, not the master.
Well, this brings us to the end of our deep dive into The Simple Path to Wealth. It's been a really interesting journey learning about these practical tips, thought-provoking ideas.
It's a book that challenges how we think about money, encourages us to take control, and inspires us to live a life of purpose.
So as you continue on your own path to financial well-being, here's something to think about. If financial security is about freedom, what would that freedom allow you to do? What dreams would you chase? What kind of impact would you make?
Something to think about. Until next time, happy investing.